In this video, I will share tips for making profitable investments based on Sir John Templeton's investment strategies. If you want to take smarter steps in the investment world, you are in the right place. Lesson 1. Turn pessimism into opportunity. In other areas of life, you should go where you look the best. Get a degree from a famous university. Get a job in a promising industry and continue to develop. Try to marry someone your friends and family approve of. In short, you should do everything you can to be the best. When it comes to investing, you should do the opposite. Unless you are the son of wealthy businessmen, you may get advice from friends and family on what not to invest in. Sir John Templeton was an opportunity hunter and a value investor. He would always buy an asset at a price below its true value and always win. He confidently said, "Buying when others are desperately selling and selling when others are eagerly buying takes courage and yields the greatest reward." This quote tells us that when people think things are going badly, you should take this pessimism as an opportunity and focus on investing. Take Sir John Templeton, for example. He built his fortune by buying companies on the eve of World War II, investing in Japan in the 1960s, and buying airline stocks shortly after the 9/11's terrorist attacks. The key principle to be aware of when investing in times of great pessimism is this: when the perspective changes, the reward is like a banquet. As a result, strong companies that seem to be experiencing temporary problems are hunting grounds for those looking for good opportunities. In other words, they don't miss opportunities like coyotes. A successful opportunity hunter must always focus on possible future events. He must buy when others are inclined to sell and reach the potential to sell when others are eager to buy. This is why you should avoid the herd mentality. Templeton not only thought about it metaphorically, he actually practiced it and ended up staying in the Bahamas. Lesson 2. What is an opportunity? When people buy a stock, they are investing in a story. You may hear advice like this stock has grown a lot and will continue to grow, and maybe they are right. But as an opportunity hunter, you should focus on assets where the price is low relative to the story. Tesla is the best example of this. You may get advice like buy Beyond Meat and collapse livestock, but that doesn't mean you should invest in these companies. If the company has a compelling story, that's when you should be very careful, because other investors always notice these stories and the shares start trading at very high valuations. Sir John Templeton is 100% sure that most of these are not opportunities. So what is his definition of opportunity? Sir John Templeton defined an opportunity as an asset trading at a discount of at least 80%. If he believed a stock was worth $100, he would buy it for $20. This was rare, but nonetheless proved to be extremely profitable. Templeton's two general recommendations, depending on your investment horizon, are 1. Use 5 years of earnings to find stocks with a PE of 5, or 2. Use 10 years of earnings to find stocks with a PE of 2. Take Tesla as an example. It is currently trading at $163 billion. Using the first criterion, it will earn $32.6 billion in 5 years. Toyota, the world's largest automaker, earned $23.1 billion 10 years ago. If we use the second criterion, Tesla would need to earn $81.5 billion in 10 years. Given its current profitability, there is no doubt that Tesla will become the second largest company in the world. This issue should be reconsidered with a healthy mind and logic. Lesson 3. Investing abroad is no longer foreign. Sir John Templeton was arguably the dean of global investing. He was adept at investing in markets outside the US and made significant gains in countries like Japan, South Korea, and China, especially when these countries were still considered emerging markets. You should capitalize on pessimism at the country level as well as at the company or sector level. That's why focus on emerging markets. Countries like Sweden and India have more to offer. This not only allows you to find more opportunities, but also significantly increases the diversification of your portfolio. Now, in the global economy, owning shares in different markets or from different currencies is the best way to reduce the volatility of your portfolio. This will increase your mental resilience to go against the herd. The most common objection to investing abroad is lack of knowledge. Relax and take a deep breath. Lack of knowledge is not always a bad thing. It can also create great opportunities for you. Just do your research and try to be better than the rest of the investors. As long as you pay attention to the situations where you are at an information disadvantage, you can be sure that success is with you. For example, if you have difficulty understanding annual reports, don't even look at the face of these stocks. Ignoring details can lead to bad investments in both foreign and local markets. The mistake may have come from misjudging a corrupt government or a corrupt top management, but this will not affect your investments. Lesson 4. Bottom-up and top-down approaches. I think everyone knows that investing abroad is a different game than investing in the local market. You have to pay attention to a lot of differences such as accounting, culture, politics. This effort will not be wasted, but it will take some time. We will focus on just a few markets. The question is, which ones should you focus on? Stop the video and guess the answer. The answer is, you have two options, bottom-up or top-down. The bottom-up approach is to screen many companies. I recommend using services like Capital IQ, Bloomberg, or Screener.co. The bottom-up approach starts at the company level. Sir John Templeton promoted this idea. He believed that in order to understand the fundamentals of a country, a thorough study of the companies that make it up is essential. The top-down approach analyzes macroeconomic indicators such as GDP growth in different countries to determine where the greatest potential for future growth lies. The top-down approach starts at the country level. Most of these companies are located in Vietnam, China, and Russia. Here you have to be extra careful not to have an information disadvantage. Try to turn it into an opportunity. Would you invest in Vietnam, China, or Russia? I would like to see your thoughts in the comments. Lesson 5. Become a pro at 100 value metrics. Sir John Templeton was right. There are more than 100 measures of value that an analyst can use to find opportunities. Knowing more than one way to find value is critical. I will give you 3 important points. You write the rest. 1. Price-earnings ratio, PE ratio. The ratio of the price per share to the earnings per share. This ratio shows how high or low the market price of a company's stock is compared to its profits. 2. Price to book value ratio, PB ratio. The ratio of a company's market capitalization to its book value. It helps to compare the market value of a company's assets and equity. 3. Gross profit margin. It is the ratio of a company's gross profit to its net sales. This ratio shows us how profitable the company's ability to produce and sell its products is. Which famous investor should I talk about in my next video? Write in the comments and don't forget to subscribe. See you soon.